Capital doesn't panic. It just relocates while the retail public treats a geopolitical oil shock like the end of days. Algorithmic architecture is quietly absorbing the discarded equity. This is a GreenCandle forensic audit. We aren't here to debate the headlines. We are here to measure the structural displacement. Today, we are disassembling 7 machines that Wall Street systematically stress-tested to harvest cheap premium. We are tracking Uber, NVDA, AVGO, AMZN, LRCX, GLW, and GOOG. Put your emotions in neutral. Let's inspect the actual plumbing beneath this sell-off. Let's pause the tape. Wall Street isn't a charity handing out free money. We are trading physical probabilities, not certainties. If the structural floors break, you take the stop loss and walk away. Don't fall in love with the machinery. Look at that 30% algorithmic haircut on the screen. Uber was dragged into the high 60s, treated as a pure proxy for the oil shock. But this isn't a broken business. It's an extreme rubber band cycle. Institutions are buying the blood, knowing the geopolitical supply issue is temporary. Notice the 51% dark pool accumulation. Big money is writing massive blocks of $65 puts, selling panic to retail and using that premium to sweep $85 late summer calls. Dealers are trapped short at $65 and will be forced to cover during the mid-April options expiration. If April 6th ceasefire talks yield an inch of progress, crude craters and transport algorithms violently mean revert. The fundamental structure of the company hasn't changed. Wall Street is just using the Middle East as a crowbar to pry shares out of weak hands. This is a 60-day sprint. We are operating against a $68.22 current price with a hard structural stop mapped at $64.50. Sovereign AI. Spending does not stop for regional wars. Look at this engineered slide from $185 down to Friday's $167.52 close. This is textbook panic, dragging the forward multiple below the broader market. Big players intentionally let the price slide to trigger retail stop losses. Check the options flow data. You will see coordinated puts selling at the $160 and $165 strikes. Smart money's building a floor out of concrete, absorbing the panic to sweep $190 out of the money calls. They're soaking up the liquidity retail is violently discarding. The fundamental reality is simple. Demand for the new Rubin architecture is entirely inelastic to Middle East geopolitics. Dealers are heavily short at those $160 and $165 levels. The April expiration will act as a launch pad, with an entry near $165.50 and a strict stop at $159.80. Taking September $180 calls immunizes the trade against the daily noise. Broadcom got caught in a blind tech liquidation, dragging the price down nearly 27% from its highs to $300.68. But look at the level 2 data. Institutions walked this price directly down into a hidden fortress of buy walls, sitting heavily between $296 and $298.50. Watch the dark pool metric, 48.5% volume. The big players are stealth loading, writing expensive puts to terrified retail traders while vacuuming up cheap June calls. The mechanics here are bulletproof custom A6 silicon pipelines and VMware cash flows are utterly immune to $120 oil. This is a 90-day digestion trade. We set a stop at $289.50 and let the unwinding of the $295 put wall fuel the initial reversal once the May Fed meeting passes. Don't look a gift horse in the mouth. Amazon dropped below $200. Caught in the crossfire of Red Sea shipping fears and tech multiple contraction retail is panicking over freight costs. But AWS, the actual profit engine, is completely insulated from physical supply chain shocks. Look at these massive bullish wrist reversals on the board. Market makers are selling elevated implied volatility puts to the public and rolling that premium straight into calls. This is a textbook pairs trade, shorting the lit retail narrative to fund the cloud reality. We call this the bipolar mispricing. The catalyst is extreme here. Late April earnings will force the market to reprice that cloud growth over retail shipping noise. We are executing a 3-month setup with June $215 calls and a $191.50 stop. Algorithms don't read context. They just execute. Lamb Research was dumped 15% of the $211 area on algorithmic sympathy, selling tied to software announcements. But geopolitics actually accelerates the need for secure, localized US and European semiconductor fab build-outs. Watch the dark pool ticker, 47% by volume with hidden walls defending the $206 to $208 zone. Institutions allowed momentum algos to crush the sector, effectively opening a trap door just so they could heavily sweep call options at the absolute bottom. We treat this as a quick 60-day sprint using May $230 calls. Once the temporary software fear narrative dies out and upcoming earnings confirm accelerating capital expenditure, the coiled spring releases. We lean against our $209.50 entry and maintain a strict $203.80 stop loss. Corning is collateral damage, bleeding out 8% into the mid-130s during a broad market de-risking. But optical fiber is the physical backbone of the domestic AI. Build-out market makers are playing a quiet game here. Look at the 49% dark pool accumulation. They're soaking up the supply without moving the lit tape an inch. Because this isn't gamified by retail options traders, it moves slower. This requires a 120-day build using July $145 calls. We enter near $134.80 with a $128.50 stop. It takes time for dark pool intent to translate into lit market momentum. Alphabet slid 12% down to $273.76, battered by AI margin fears. We rank this last because corporate ad budgets are always the first thing slashed during an energy-driven stagflation scare. However, institutions walk the price perfectly down into massive $270 buy walls to defend the floor. Check that 8-to-1 call to put ratio on the block trades. Big money is betting the underlying cloud infrastructure will carry the weight, while the ad spend narrative takes a beating. This requires a long 150-day build using August $290 calls. With a firm stop at $264.50 Your objective is not to outsmart the geopolitical news cycle. It is to draft behind the heaviest capital flows in the room. Honor your structural stops and ignore the static. That is the green candle.